we have essentially decoupled what the government thinks is happening with what the capital markets needs people to know. And that's a really unique dynamic. Like, I mean, I'm not nearly as successful as Stan or have been in the markets as long as him, but in my 20 years, this is the first time I've really seen that. So just to give you a sense of this, you know, the markets are now acting to establish inflation expectations that the Fed just seems to not want to do anything about. And for just to give you guys a sense of this, like, you know, when in February, the markets really kind of had its first capitulation, what happened was that all of a sudden people digested all these facts that Stan just said and realized, wait a minute, like all of this money is going to drive prices higher. And so what they did was they took the yield on the 10-year bond up by like 100 basis points, and the markets freaked out. They went from like 0.75 to 1.75. And the Fed came out and said, hey, hold on, nothing to see here. Everything's going to be fine. But then everything since then has been sort of leading to this realization. Commodity prices are up 50%. There's this kind of like joke that, like, you know, you see a bed of lumber moving across a railroad. That's like $1 billion of lumber just because of how expensive it is. You know, there are shortages everywhere. You'll be shocked to know that today, Chipotle put out the following guidance, which is they said they are increasing the minimum wage to $15, and that within 3 years, you can make $100,000 a year at Chipotle.
Yeah.
That is as much as some engineers and coders in the United States. Dara Khosrowshahi, the CEO of Uber, said on the Uber earnings call last week that the average hourly rate that some drivers in New York, Uber drivers in New York, were getting paid was $38 an hour.
What?
$38 an hour. So what does all of this mean? I think what Stan is trying to say...
$100,000 a year.
But we're in this weird place where we've decoupled the government institution that's responsible for fiscal stability, and then the overall capital markets used to work in tandem. And they're no longer working in tandem because you have a narrative and a set of data points that aren't supported by the facts. And so this is an interesting thing. So in the CDC versus the American people example, there's no way to push back, right? I mean, governors can act independently, cities will act independently, but at the end of the day, you know, the teachers' unions are working with the CDC, the school camps have this guidance, and you're stuck in this morass. In the capital markets, that's not necessarily true, and so you can change and you can re-rate asset prices based on sentiment. And I think what everybody is saying in this example is, we're past the emergency, we've put too much money in the economy, we need to reopen, and we now need to face the fact that there are massively rising prices, which means that there will be inflation. And if you don't act, the capital markets will continue to act for us. And so this is an example today where you're just seeing a bloodbath in the markets. And by the way, the only time that two government officials tried to be on the either side, Janet Yellen last Friday kind of casually in an interview kind of put her toe out in the water as Treasury Secretary and kind of said something that said there could be inflation, and literally was hand slapped and had to put out something that disavowed her comments less than 24 hours later. So that's where we are.
There's a bloodbath in the markets today, and there's been one for the last couple of months, and in particular, all the growth stocks have been hammered. And just to build on what you're saying, Chamath, so there's an announcement today, there's some data that the inflation, the CPI, is up 4% and climbing. And so people are now pricing in big interest rate increases. And so that makes growth stock, that hammers growth stocks because all the earnings are in the distant future. And so they get now discounted at a higher rate. And so the valuations get absolutely hammered. So, you know, it's absolutely souring. The markets are basically souring on this Biden agenda. And, you know, I'm beginning to wonder if Biden's going to be a Jimmy Carter here, because frankly, all he had to do was leave things well enough alone. COVID was winding down. We had a vaccine. All they had to do was distribute it to as many people as possible, end COVID, let the recovery take shape. And instead, they pushed this insane $10 trillion agenda of taxes and spending that are now overstimulating the economy, that are causing inflation, that are now creating interest rate increases.
No, that's not true yet. Meaning, he did do a good job on the vaccine, David. But then to your point, the federal government's posture on reopening has still been stunted. And he's proposing so much more incremental capital, which we all know probably will not be efficiently spent. And there isn't any other good ideas. And so he believes his path to re-election, which is true, is to spend and to put money into the economy.
I think it's going to backfire. I think it's going to backfire massively.
And to tax, right? So he's trying to offset with higher taxes on the wealthy, which from his point of view is not going to affect him. And the analysis is probably fair. It's not going to affect his voter bloc significantly.
This is going to backfire massively. Look, if the economy turns, we were set for a post-COVID boom. And right now that is all at risk because, Chamath, like you're saying, they're keeping the economy closed or parts of it way too long. They then overcompensate for that by printing a ton of money, and then they overcompensate for that by raising taxes too much.
Just to build on that, so that second step of their overcompensating their inability to open with money is so true, because then what happens is your labor force stays impaired because people make enough money by not working.
This is the key issue right now for a lot of businesses. I mean, you have restaurants that are overbooked, cannot get servers. Jim Cramer was saying he's up to $18, per hour per servers. He's going to move it to 20. It won't make a difference because with that extra 300, I think, in federal unemployment, plus 3 to 700, I think, depending on where you are, you're now at 60, 70, 80%. And people are like, well, people will still go to work. And it's like, yeah, but you're saving commuting, and you probably have side hustles, and you've lowered your commute expense. So what is going to incentivize people to go back to work? We are now running a dry run with cryptocurrency and, stimulus, a UBI experiment. And the result of this UBI experiment is negative economic growth or throttled economic growth. We cannot be productive if people don't want to work and contribute.
So just to your point,
we need
on
more
Friday,
people to go to work.
So just to your point, on Friday, Montana, which was part of the federal government's, pandemic-related UI benefits program, basically said that we're canceling those benefits and we're opting out. And on top of that, I think they're now offering a $1,200 bonus to return to work. And the problem is because Montana now has a severe labor shortage, but it's not just Montana, it's every state in the union. So we have these two opposing forces, right? We have so much stimulus, we have an undermotivated labor force, we have more taxation that's also just going to be wasted, so very poor ROI. And then now we have input costs going up and prices going up to try to attract people. It's all going to drive price inflation.
I think we have to stop sending people free money so they go back to work. Like, this is a very hard position to take. And we now have this occurring on a micro basis in California. We have is it true we have a $75 billion surplus this year as the city devolves?
Yeah,
and now we're going to take that, and instead of lowering taxes and maybe trying to get Tesla or Oracle or other venture capital firms that have left, instead of doing that, what could we do, David, with that $75 billion?
So great point. So the $75 billion surplus, 1/3 of that is from the federal bailout, which obviously we don't need, and that's the money printing that's coming out of Washington.
So we're giving that back, right, to another state that could use it?
Good luck, exactly. No.
Okay.
The other 2/3 is because last year we had all these unexpected tax receipts from the stock market boom. And so you had all these California taxpayers paying capital gains on that. So, but what this highlights to me is, and what I wonder about is how many of those taxpayers have left the state, because we know that we had net migration loss of 182,000 in 2020. So how many of those people left the state and won't be paying taxes this year? And if Biden breaks the